Well, I think it's safe to say the data was leaked today, judging off of the market's reaction and sell-off that we've seen. Now, some of you may say, well, how do you know the data is leaked? Well, let me tell you. Nvidia was down 9%. 30 minutes after markets closed, there was news that they were being subpoenaed. The news was not true, but Nvidia was down 9% because big money was tipped off on just that. When the BLS did their yearly revision just a couple of weeks ago, major banks and institutions got the revision long before it was actually published to markets broadly. So it does seem like someone in the government at the BLS agency is leaking data. It also looks like Bloomberg and other sources leak data to big money before we ever hear about it. And heading into tomorrow, well, with such an important event, I would be shocked if the sell-off that we've seen today had no correlation to a bad jobs report coming tomorrow. So I'm going to give you the bad news first. The bad news is we're probably going to get a bad jobs report tomorrow. The good news, if you want to know the good news, is it sets us up potentially for a buy the dip opportunity in the coming weeks. See, September is basically a self-fulfilling prophecy, as a lot of fund managers have said on CNBC recently, just to quote the many of them. September is by far the worst month for equity markets in recent history. And it does look like this September is setting up the same way. In fact, the best September we have had since 2020, so that is 4 Septembers since then, is negative 5.16%. That was in 2020. 2021 was negative 5.31%. 2022 was negative 10.5%. And 2023 was negative 5.81%. The 6-year average return for the month of September is negative 4.5%. That is by far the worst month. Historically, over the past 10 years, you're down about 2.9% for September. The only other month that is down historically in the last 10 years is December, and you're only down about 0.2%. September is really a standout bad month. And especially as the Fed is going to start cutting rates here soon, all of the attention from Wall Street's perspective is on the economy. Is the Fed too late? Is the Fed cutting rates at the right time to engineer a soft landing, or is there already too much damage that has been done? The problem lately is there's a lot of mixed data. The data that we got today, okay, the ADP employment change came in at 99,000 jobs. We were expecting 145,000 jobs. That was a massive miss, and this is the lowest or smallest ADP number we have gotten since 2021. Like, this is a bad number, right? That's not good data. That's kind of recessionary like data. But then we got ISM services that came in a little bit better than expected today. ISM services PMIs came in at 51.5. We were expecting 51.1, and last month was 51.4. So that was a little bit better. Business activity came in at 53.3. We were expecting 54. Last month was 54.5. So that came in worse than expected. That's getting closer to recessionary. Employment came in at 50.2. Last month was 51.1. The estimate was 50.5. So that was worse than expected, suggesting tomorrow's BLS report for employment's probably not going to be too great. But look at that, new orders, which is probably something you would expect to slow down if we're going into a recession, came in at 53.0. We were expecting 51.9, and last month was 52.4. So that came in strong today. Prices in the service sector also came in strong at 57.3. The estimate was 56.0. Last month was 57.0. So there's just a lot of mixed data, like almost every day. There's some good data, there's some bad data. Like, really, if you wanted a narrative right now of, bullish, bearish, recession, no recession, you can create that out of the data that we're getting right now and have a strong argument. Now, I do think the recessionary argument is a little bit stronger at this point because the data we're getting is coming in a little weaker than stronger, but that's why tomorrow is so important. Tomorrow, we will get the non-farm payrolls report. You're expecting 160,000 job ads. I don't think the jobs number itself is too important to markets, as long as it's not super low. A super high number would be great news, like 200 plus thousand, hell, 300,000. Yeah, markets would love that. Okay, would absolutely eat that up, and you'd have a great day tomorrow. If we come in 150,000, I don't think that's a huge problem. If we come in under 140,000, under 130,000, Wall Street's not going to like that as much. It's really the unemployment rate, okay? So Wall Street is expecting the unemployment rate, which is at 4.3% today, to drop to 4.2%. So you're expecting a drop in the unemployment rate. Well, historically, when we're going into recessions, you normally get this stair step up in the unemployment rate, and then you tend to get a big move higher, like quickly. Okay, you've seen this throughout time. If we really want to just highlight any of these periods, let's just highlight this period here. You tend to get kind of a slow and steady rise in the unemployment rate, and then just boom, it starts to take off. Same here, slow and steady rise. Boom, you start to really take off. In just a couple of months, you go from like 6% unemployment to 8% unemployment. Same here, slow and steady rise, and then a big rocketing. I mean, literally every single time. So for tomorrow's unemployment rate, if it goes down, that's great. Last month, we actually jumped from 4.1% to 4.3%. Let's say we do that again and jump from 4.3% to 4.5%. You're probably going to have a 5% down day tomorrow for the S&P. Maybe more. Because we've bounced back so aggressively from this 10% correction that we had based on the narrative that the, soft landing is intact, that we're not actually going into recession. Technically, if we want to get super technical, even at the August 5th lows, markets were not pricing in any chance of a recession. Recession odds were still at 0. Now, some of that could have been just the yen carryover trade. Investors didn't want to price in a recession based on that. Fine, sure. But even down here at a 10% correction, we were pricing in no chance of a recession. If you get the unemployment rate that goes up in any kind of material way tomorrow, even if it goes up 0.1% to 4.4%, we're going to have to start pricing in some chance of a recession. That could take us down 20% from here, just to price in like a 20-30% chance of a recession, which I think the actual odds are like 50-50, maybe 60-65% chance of a recession. In other words, you're looking at some huge downside. This could be the worst September you've had since 2020. You could have a worse September than, where's the chart here? Than 2022 when you were down 10.5% easily if tomorrow's unemployment rate goes up like it did last month. And that's where I think the risk comes in here in our markets, because what if unemployment does fall? Maybe it falls more than expected. Maybe the jobs report comes in really good. Well, one, that's not what markets are suggesting will happen today. We'll talk about that a little bit more in just a minute. But what's the upside here? Really? Like, with earnings expectations as high as they are for 2025, there's really not much room for upside at this point. If you consider from all-time highs, let's imagine markets are at all-time highs around 565 for the SPY, to 580, which is most average price targets for the S&P by the end of this year, that would only be upside of 2.5%. From today's prices to get to 580, that would be upside of 5.88%. The downside could be 20% or more by the end of this year if we start to slip into a recession. Or if markets need to start pricing in some chance of a recession. I think it's a critically important aspect of investing right now that you need to understand. Markets are not pricing in any chance of a recession. Literally a 0% chance of a recession. Keep this down to the basics. Do you think there is a 0% chance of a recession or not? Do you think Wall Street should be pricing in a greater chance of a recession? Every one of you guys should say yes. No matter how bullish you are, there is a greater chance than zero of a recession. So that pricing in of a recession can be ugly for stocks. And it will be ugly for stocks if that's what happens. Now, as I just mentioned, reading the tape, which means reading the markets, what sectors are doing well, what stocks are outperforming, what's the data and how does that read through to markets? Well, when you actually got the data this morning, markets went higher on that, right? You actually went higher on that, which doesn't make a whole lot of sense because ADP came in really bad. But you started selling off out of nowhere, almost like hedge funds, institutions, big money managers, market makers got the jobs report today, like right here. They got the jobs report. Now, again, why is that happening? Probably because if a market maker or a Jane Street or a Citadel or a State Street or a Sequoia or, any of your major banks, Bank of America, Wells Fargo, Citi, call it even BlackRock, Vanguard, or, JP Morgan, any of these banks, any of these financial institutions, if they are caught off sides with, let's say, a really bad jobs report and they're not positioned for that and they're not hedged appropriately for that, they could start to see some really big losses, and that could become a systemic risk, just like 2007. If perhaps the government or someone at the BLS was leaking some of those reports to big banks or, firms for that matter, maybe there would have been less of a systemic problem at that time. Maybe there would have been less bankruptcies, less companies going bankrupt. So I see why, I don't want to say the government necessarily, but someone at the BLS, someone at Bloomberg and other news outlets are leaking news beforehand, and it's blatantly obvious to see is because of that systemic risk if firms start to blow up. Now, retail investors, they don't give a shit if you blow up. They don't care if you make the wrong trade on the wrong data. They don't care, okay? Let's be honest about that. But for systemic financial health and stability, that is why I think they're leaking the data. So reading the tape of our markets today, the sell-off that we're seeing, seemingly with no news out of nowhere, it does suggest to me the data tomorrow could come in pretty bad. CNN's fear and greed indicator today is sitting at 48, which is neutral. Yesterday you were at 52, which was also neutral. Market momentum is fear. Stock price strength is neutral. Stock price breadth, extreme greed. Put and call options is fear. Market volatility is neutral. Safe haven demand is greed, and junk bond demand is in extreme fear. And these are the kind of things that are being talked about over on X today and amongst hedge funds, institutions, and Wall Street. Goldman Sachs puts out a new note today. A 50 basis point unemployment rate increase has nearly always predicted a recession in the US, and you are at that level now. And what tends to happen is it tends to rise dramatically once you hit this level. That tends to be really the inflection point of a steeper rise. Michael from Bloomberg says, quote, the US unemployment rate is up 90 basis points from the cycle low and up 80 basis points year on year, a move that over the past 75 years has only been seen during recessions. There are plausible arguments why this time could be different, but we nonetheless think that the balance of risks is skewed towards further labor market weakness. And again, that is something that Wall Street is not pricing in, not expecting, and that's the issue. Even if we never get a recession, like it never actually materializes, we never get 2 consecutive quarters of declining growth, there will be a moment of greater fear. There will be a moment of pricing in the chance of a recession. And we're not even close to that point right now. And this pricing in of a recession will lead to dramatic downside for stocks. And that's why I think there will be a better, buying opportunity coming. Think about even 2022 for that matter, from the, peak in 2021 down to the low in 2022, you were down about 27%, and we never went into a recession. At that point, markets had a 100% chance of a recession within the next 12 months. And that's why stocks bottomed, because when you're already pricing in a 100% chance of a recession, how much lower, can things go? You actually at that point have to see a recession materialize, and then you need to see a steeper than expected recession actually materialize. The difference between 2022 and now is 2022 you were pricing in a recession, today you are not. Now, would we fall to 2022 levels? I mean, it's possible, I guess improbable. That would be downside of 38%. Definitely possible, but that would be like a 100% chance of a recession at that point. I think if you were to fall like 26% back to October 2023 lows about a year ago, almost exactly about 11 months ago, if you were to fall 26% from here, then you'd probably be pricing in a pretty good chance of a recession. You'd probably be pricing in like a 40-50% chance of a recession. But that's it. Even a 26% decline from here, I don't think would be pricing in much of a recession. I think you may need to fall more than that before things are all said and done. Now, maybe the economic data only justifies a, 26% drop, a 50% chance or so of a recession being priced by markets. And that'll really depend on the unemployment rate. That'll really depend on the economic data that comes out over the next couple of months. And that's why tomorrow is so important. Really, the bottom line is tomorrow we either start pricing in a recession or we really get confident of a soft landing. That's what is at stake coming tomorrow. The latest AI investor sentiment survey that came out yesterday shows bullish investors at 45.3%, neutral investors at 29.8%, and bearish investors at 24.9%. So bearish investors actually dropped week on week. Bullish investors dropped as well week on week, but you did see a large rise in neutral investors week on week from 21.9% to 29.8%. And again, I think that accurately represents how a lot of people feel right now. It's like nauseously neutral. Like there's the case for a lot more downside. There's the case for more upside from here. And it all hinges on the economic data that we don't have yet. Big money has this data. Some institutions, I'm sure, judging off of the tape today in markets, but we don't. So it's hard to say. But judging off of the sell-off that we've seen today, I would go out on a limb and say the data's probably going to come in on the bad side tomorrow. The percent of stocks currently trading above their 50-day moving average is down to 52.1%. So basically a coin flip of stocks trading above their 50-day moving average or not. And there is a lot of room for a larger rally here, for a breadth thrust, for stocks to participate and markets to go higher. There's also a lot of room here for a fall as well. Take back to, October, November of 2023, only like 15% of stocks were trading above their 50-day moving average. You're at 52% today. There's a lot of room for more weakness here, but then there's a lot of room for more strength as well. Take, for an example, the start of 2024. You had 86%, 87% of stocks trading above their 50-day moving average. Today, you're at 52%. So there's definitely room in either direction here for weakness or for strength. Now, also worth mentioning that tomorrow we will get Fed Waller that will speak at 11 o'clock in the morning, and then that starts the Fed's 2-week blackout period. So Fed Waller is the last Fed official that we will actually hear from. We actually have Fed Williams as well at 8:45 in the morning tomorrow, but Williams and Waller, they're the last Fed officials we'll hear anything from heading into the first Fed cut September 18th. So I think there's going to be a real narrative that they need to push, whether that is 50 basis points or 25 basis points, depending on the data coming out tomorrow. It's the last messaging you can do to markets. Should also mention today and after hours, we have earnings from Broadcom, UiPath, Samsara, DocuSign, Braze, Zoomies, and Smartsheet that will report earnings. And then tomorrow morning, you have earnings from Big Lots. With that said, again, if tomorrow is bad and the unemployment rate does rise from 4.3% to let's say 4.5%, I could envision a 5% drop tomorrow. That would put markets around 520 for the SPY. If we do have a good jobs number, if we do have the unemployment rate that goes down as expected, then I think you could see a 2 to 3% upside move. A 3% upside move from here would put you back to about 565 on the SPY. So I do think we're going to get a big move in either direction. Not going to take much of a move of that unemployment rate to get markets excited or to freak markets all the way out. So let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.